Bringing Aureus Firestone, Chairman, CEO, and co-founder of Aureus Asset Management, as well as a CNBC contributor. Carrie, good morning.
Hey, Mike. Thanks for having me on the warm-up session for the Major League Baseball All-Star Game.
I thought you might have something to say. Hey, at least, look, the Yankees can't lose today, so I'm happy. But
we're on the same team.
Your take on the market here in terms of, just even the broad setup, right? We obviously have the inflation numbers coming out. The market was on edge about what the bond market was doing with yields sinking more than most expected. What does it mean for you, your style, and, with the market up 17% year to date, what do you expect in terms of returns to come?
Yeah, well, huge market. And it was interesting, if you watched the action yesterday, the top of the leaderboard seemed to be financials. So we had, SL Green, American Express, Charles Schwab. But right below that were some big tech names. So, Alphabet, Facebook, Peloton, a name we own. They were the next highest on the board there. So it's showing that the market is not one-dimensional. It has some reopening names, but we're reopened already. And it's looking at growth also. Tech has had a big rally. So we seem to be picking and choosing among the type of names that investors think can have good quarters, but raise guidance, can show high margins, and explain that they can have pricing power, that inflation is not the threat to them as it might be to some sectors. And that, I think, is going to sustain this rally, particularly as the big cap names that have been quiet for months began, a resurgence a couple of months ago and are taking a lead and moving the whole market higher here.
Yeah, I wonder what the takeaway is from that. You mentioned how the growth stocks certainly have really carried the market in this last little phase to new records, even though it has not been, either cyclicals or growth. But there's a sense out there that that's just been kind of while the market digests the possibility for some kind of a soft patch in the growth path here. Do you think there's, the kind of macro risk being sniffed out here by the growth stock strength, or is it just kind of, good companies that did nothing for long enough?
Yeah, I think you made a good point. The market, with interest rates coming down, became more aware that the type of GDP we're seeing this year, 6.5%, 7%, is not sustainable, and that the stimulus packaging will end. So not all this money that's going into personal income. You have to then focus once more on who's really growing, who's got top-line growth, who can keep their margins, who can pass on prices. And that is more growth than value traditionally. Packaged goods aren't going to do very well by comparison. Food stocks, this quarter. So the market has really made an effort to go with what's going to work over the next year or two if GDP is more in the 3% range, not higher, not 4 to 7 or wherever, 7.5 where we're running now. I also think it's meaningful that the market's narrowed. So at the beginning of the year, we had most stocks in the S&P beating the average. Last year, that was not true. Much narrower market. In the last month, only 29% of names are ahead of the S&P. That's a little bit of a concern. That can last for several more months. It did for most of 2020. And we're seeing that again with Apple, Amazon, Microsoft all hitting new highs, up over 20% since early March.
Are there any areas that you look at, that you play in, that you feel as if, the earnings growth path is underappreciated? It just seems as if right now, earnings are going to be up huge for this reporting quarter based on year-over-year numbers, right? 68% or something like that for earnings per share is the forecast.
Definitely.
Going back 2 years, it's 12% over the comparable 2019 quarter. So that's healthy, but that's not extraordinary. I wonder what themes might be coming out of your work that say, okay, now we believe there's some, neglected or at least, areas that have not been fully recognized as having potential.
Yeah, so good question. I think that what clearly has been recognized recently, financials have been recognized. Some of that reopening trade, industrials, that's not where we think there's big value. Tech names that have been ignored, like CRM as an example, a stock that had a big move last summer, now it's this summer. It underperformed a lot, starting to come back. Some of the medical device companies, technology names that really were just hit the skids with no discretionary surgeries could start to show some improvement. Healthcare has been coming back stronger lately. We talked about tech, but healthcare again was ignored, and it's been rebounding.
Shepard Smith here. Thanks for watching CNBC on YouTube.